Okay. As you may recall, last time we were talking about how important it is to sign the contract properly to make certain that you limit your liability. If the buyer is an LLC, you need to always state the name of the LLC. In theory, you could just use the assumed name, but I believe that you always want to make it absolutely clear for whom you are acting, and so I like to spell out the full name of the LLC and then specify Texas Limited Liability Company. Now the problem is, when you're using the TREC contract forms, you got that one line at the top where it identifies the buyer.
Yeah.
You always, 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 on the signature line, should include the name of the legal entity, and then you should have the word by, and then the person's name underneath it printed, identifying that person as the officer that is acting.
Gotcha.
The nice thing about the TREC forms is they actually have two signature lines for buyer. So you can write on the first line the legal entity's name, then on the second line strike through the word buyer and put the word by.
Okay.
And then you can sign it, but always, always make it clear by printing underneath the line, or at a minimum put a comma after your name where you've signed it and put the word manager or officer. There's even an argument that you ought to have your checks pre-printed to have underneath the signature line authorized officer, so that when you sign your checks you don't forget to state your capacity in which you're signing the check. If you are buying the property or selling the property as a corporation, you're going to do the same thing, except you're going to have the word Inc., and you're going to also use the byline, and you're going to put your capacity underneath that. If it's a limited partnership, things get a little bit more complicated, because a limited partnership acts through its general partner. So you're going to have two bylines. The first byline is going to state the name of the legal entity, which is the general partner. And then you're going to have another byline for the person who's signing on behalf of the general partner. So you can use this model, but this is the way it ought to be done to make sure you've acted only in your capacity as an officer of the general partner, and to make it clear that the limited partnership is acting through its authorized general partner.
I never do that.
Yeah.
I mean, as partnership.
Right.
Stuff, but it's good stuff.
Well, it is good stuff.
It might raise, to me, it kind of raises like some questions, and I just want to get the deal done. But you're saying, hey, it should be inked properly.
Exactly. In fact, I tell the story. One of the very first clients I ever represented was a great client, went on to be one of my very, very biggest investors. He's still one of my very best friends. But the first case I represented him, he was being sued by the law firm who had previously represented him. And they were, he thought, representing his limited partnership. But when they prepared the fee agreement, that they asked him to sign, they didn't have him list his capacity acting on behalf of the general partner, and they made the argument that therefore he should be personally liable for the legal fees that that the limited partnership had incurred. And he ended up having to pay those limited. I wasn't able to win that case for him because he hadn't limited his liability by putting carefully that he was only acting on behalf of the corporate general partner in his capacity as president of the corporate general partner. Now, a corporation, just as I said with the LLC, its shareholders, its directors, its officers generally have no personal liability for contractual liability.
Let me. Real quick question is on the assignment.
Yes.
You talked about, do you put and/or signs in the buyer line? Just a real quick, or do you?
My answer is no. I do not put and/or assigns in the buyer line. Legally in Texas, you have a right to assign a contract, except for a lease. Even without saying it, you have the right to assign a contract unless the contract extends credit to the named buyer. Any time the buyer is not being extended credit by the seller, the buyer has the right to assign his contract. But my own opinion is the smart way to play the game is to have a separate clear contractual provision that says you have the right to contract, to assign it, but more importantly, that if you assign it, that the seller agrees that you are going to be released from liability as the seller if the party to whom you assign it agrees to assume the liabilities of the contract.
And that's where the Exhibit 1.
And that's where I use an Exhibit 1.
Previous slide, the Exhibit 1 is what spells that out.
Yes, and frankly, in the exhibits that we provided for Flip That Contract at the last presentation we made, I included all of that language available for the people who were, I just didn't in this one because we weren't going to talk about everything we can talk about. We're going to run out of time otherwise. But the same principles that we talked about with a limited liability company apply to a corporation. Shareholders, directors, and officers generally have no personal liability for contractual liability if the contract's signed properly, the corporate franchise taxes are paid. There are some exceptions. I'm going to talk about them in a minute, but shareholders, directors, and officers generally have limited liability for tort liability if the corporation's franchise taxes are paid. But again, the individual conduct, you can't throw acid in somebody's face and say, oh, I was only acting in my capacity as president of the corporation. Your own personal conduct is going to be subject to liability, or you're going to have to be responsible for the consequences of your personal responsibility. So you can't just drive the company car, have an accident, and try to claim that only the company should be liable, your individual conduct. That's why you need to get liability insurance, and you still can't commit fraud or intentional torts or violate the DTPA. And again, the problem is you can't get liability insurance for those acts. So one, don't commit those acts. Two, get liability insurance for your negligence. And then three, always sign your contract in the way that will limit your liability because you'll only be acting in your capacity as the officer. There's a $308.10 filing fee if you pay it by credit card. There's same franchise taxes are going to be assessed against corporations that we talked about previously. By the way, I think this is incorrect now. The S corporation election now is limited to 100 shareholders. And by the way, you can have even more than 100 shareholders if there are some related family members that are investors. But you can't have as shareholders other corporations or LLCs or limited partnerships. And it files a Form 1120-S with the IRS, and it's just like a partnership, it's a reporting entity only. The taxable income and taxable losses are determined at the corporate level, but then there is a K-1 that allocates to the shareholders their respective share of that income and losses. The same trap for the unwary can be applied here. If the corporation doesn't make any distributions of cash to the shareholders, that doesn't matter. They can still have allocated to them taxable income, and they then are going to have to pay income taxes on their share of the income, even though they didn't get any cash distributed to them. Now, the real reason, a big reason that a lot of people recommend and use an S corporation is that because there won't be any employment taxes, Social Security or Medicare, on distributions of dividends to the shareholders. And that is a way to put money back in the hands of the shareholders and not have to pay Social Security and Medicare. But if those shareholders are employed by the corporation, then you have to pay those shareholders a reasonable salary. Otherwise, the IRS is going to come along and argue that what you have in fact done is to simply disguise the fact that you've paid them a salary, or claim that you haven't paid any salary, and then they're going to assess delinquent Social Security and Medicare and penalties and all the rest. So it is a way, as long as you pay a reasonable salary to the employee shareholders, to avoid some of the Social Security or Medicare charges that might otherwise be assessed. Now, a C corporation, most people right off the bat assume that a C corporation is bad because it's going to be subject to double taxation. The corporation is going to have to pay a tax when it files its tax return because it's a separate taxable entity. And then when the corporation turns around and pays a dividend to the shareholders are going to be taxed again. So an awful lot of people assume that therefore a C corporation subject to double taxation is automatically bad.
That just sounds bad.
It sounds bad. Just double taxation, double and tax, don't go together. That double bad. You use a Form 1120C to file with the IRS, but a C corporation is the only legal entity that is entitled to a medical reimbursement plan. And what that means is, as long as you don't discriminate, you can reimburse your employees for the unreimbursed medical expenses that they have. The corporation can make that reimbursement to the expense to the employees. The amount that is reimbursed to those employees is deductible against the corporation's income, but the amount that's reimbursed to the employees is not taxable to the employees. Normally, as an individual, you're not entitled to deduct any of your medical expenses until they exceed 7.5% of your adjusted gross income. You can have $100,000 of adjusted gross income and not be able to deduct a single dollar of your $7,500 of medical expenses that you may have incurred. And if you finally got $7,501, you'd only get to deduct $1. But the corporation can deduct all of the medical expenses that its employees incur that are not otherwise reimbursed by insurance, etc. And that can include their copays, that can include their deductibles. It can reimburse the employees for those amounts. It's not income to the employees, but it's a deduction against the corporation's income. Incredibly powerful tool. And by the way, most people think in terms of medical expenses only being those things that the insurance company would reimburse them for. But there are lots and lots of medical expenses that are legitimate medical expenses, but that insurance doesn't cover, like aspirin or the hot water bottle, or the doctor tells you you need to go to an exercise class for your heart. Whatever it may be, those are legitimate medical expenses that you've incurred that are reasonable and necessary and are they are medical expenses, and your corporation can reimburse them and arguably be entitled to deduction against the corporation's income, but it's not going to be taxable to the employee. Now, you can't discriminate, so you're going to have a plan that will be consistently applied. But guess what? If you're the only employee, that means you get this benefit that you wouldn't otherwise have gotten. And then finally, the fiscal year is a possibility. Now you can set up a fiscal year that's, say, January 31. Well, what's the benefit of that? Well, the benefit of that is you can wait until after January 1 before you pay a salary or a bonus or a dividend, and it's going to fall into next calendar year. So if my clients form a corporation today in 2011, but we have the fiscal year end January 31st of 2012, we might wait until January 2nd before we pay bonuses or dividends. It'll fall into the first corporation's fiscal year, but it falls into the calendar year 2012, and my client, the individual, won't have to pay taxes on it till April 15th of 2013. So he gets a deferral by using a little bit of tax planning. A corporation is also a separate tax-paying entity. That's the first level of taxation. But guess what? The first $50,000 is only taxed at 15%. Well, if you don't pay a dividend, when you don't have to necessarily pay a dividend until the retained earnings get to be very, very large, now you got 85 cents in which to reinvest. A lot of my clients are in the 31% marginal income tax bracket, and if they don't use a C corporation, they're going to pay 31 cents of the last dollar that they earn, because they're in that marginal tax bracket. They're only going to have 69 cents in which to reinvest, where they could have reinvested the monies from the corporation. They'd have had 85 cents to reinvest. Now, you might argue, yeah, but I got to take some money out of the corporation and I'll have to pay a dividend. Well, right now, there's only a 15% tax on dividends. So even if you pay the first 15% at the corporate level and then pay a dividend, that's only 15% of 85%. That number, trust me, when you work it out, is 27.75%. 27.75% is less than 31%. So there are times, if you're in a high enough tax bracket and if the income at the corporation is low enough, that it makes a great deal of sense to use a C corporation.